Given the wage data in this week's employment report, it might be a good time to take a walk down memory lane to remind ourselves stocks and bonds could get hit hard if inflation picks up. To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. The number of jobs created in this month's employment report came in well below expectations. Therefore, we might have expected on Friday to see bonds rally, given weak economic data typically tells the markets that the Fed will put off rate hikes, and typically that's positive for fixed income. TLT did not follow the expected script on Friday. This is the previous close. It gapped down at the open and remained weak during the entire session, which is shown here. Also, physical gold, or GLD, in the ETF world was up on Friday. And as we know, gold can be used as a de facto currency, protecting against depreciation of paper currencies. Obviously, markets move based on a countless number of factors, but one hypothesis may relate to the wage data that was contained in Friday's non-farm payrolls report from the LA Times. Wage growth continued to be solid. The 12 months ending April 30th, average hourly earnings have increased 2.5%, well above the low inflation rate. Therefore, it's possible the downward movement in TLT and upward bias in GLD are related to the market's concerns about current Fed policy and the potential for future inflation. Now, looking at text from Bloomberg, some of the main headwinds holding back inflation have seemingly begun to clear. Oil prices are back above $40 a barrel. The dollar has weakened against a basket of global currencies, and there are indications of wage growth skipping down. If we are looking for reasons why the Fed is potentially still going to hike in June, it is that wages really are starting to pick up. We could replace wages with inflation. I want to make it abundantly clear our purpose for talking about inflation and inflation expectations has nothing to do with predictions. We're simply trying to better understand possible future outcomes. It should be noted that inflation expectations, for the most part, have not broken out. This is tips relative to standard treasuries, IEF, so TIP, relative to IEF in the ETF world. It's a weekly chart. Notice inflation expectations for the week were still down, and the trend is still down. So in terms of the topic of inflation, it will become more relevant if this ratio can break to this side of the blue line and hold above the blue line, and more importantly, start a bullish trend for inflation expectations in this direction. All of this is to be determined, and none of the topics that we're going to cover in the next few slides will impact how we manage in any shape, form, or fashion. That's always done by the hard data, including this type of hard data. One of the strengths of the CCM market model is it uses that hard data to determine where the pockets of conviction are. In our lifetime, for the most part, in our professional lifetime, stocks and bonds, for the most part, have done well. Hypothetically, if inflation were to pick up, it is prudent to remind ourselves that stocks and bonds both could struggle. InflationData.com tells us that the average annual inflation rate between 1970 and 1980 was a whopping 7.25%. Point of the exercise. This table shows us that between 1969 and 1981, returns for the S&P 500 here and 10-year T-bonds here were relatively disappointing, especially if we adjust them for this type of inflation rate. Look at the returns for bonds here and then adjust them for inflation, and obviously they're going to look quite a bit worse. If we were to move into a period similar to this, and that's not a prediction, this is purely hypothetical, the reason why we're covering it is asset class behavior, just like the line on the previous chart, is somewhat pushing the inflation envelope. It's possible we're going to move to the other side of that line. If that's the case, and inflation takes hold for an extended period of time, stocks and bonds might disappoint, and commodities might do well. Those of you that know your market and inflation history, you know that the CRB index, or a basket of commodities, did very, very well from roughly 1969 into the early 80s. Look at the slope of that line here. Moral of the story, we should be open to looking at all asset classes where pockets of conviction may develop. The model, the rules, the hard data, and the charts, and maybe most importantly, the ETF scoring system will help us find those pockets of conviction when they inevitably emerge at some point. Now we're looking at the federal funds rate, or a chart of interest rates from 1997 here to 2016 here. Point of this exercise: has the Fed done anything to prepare or to start to combat potential future inflation? The chart speaks for itself. The answer is a definitive no. They've done nothing. Therefore, if inflation picks up, it is possible that what brings an end to the long-term bull market in stocks and bonds is the scenario that we've discussed in the past. And that scenario is inflation forces the Fed to raise rates. And if you know your market history, and if we look at the Fed's MO, common sense tells us this Fed is probably not going to raise rates unless they are forced to. One of the ways that they would be forced to raise rates based on their dual mandate would be that if inflation clearly starts to push the envelope, and it could be at a point where they could be perceived to be losing control of inflation. So if we raise rates here, that could be bad for stocks, and it also could be bad for bonds. Just want to reemphasize, the little stories in history will not determine where our assets will be invested. The hard data and the facts and the evidence and asset class behavior will make those decisions for us. Therefore, if inflation does pick up and commodities are the place to be, that will show up in the data. If inflation expectations bounce off of this blue line, as they did in 2014, and stocks were weak in this instance, bounced off, stocks were weak in this instance, and then inflation expectations fell in both cases, then bonds might be the attractive option from a hard data perspective. Maximum flexibility when we get near these potential inflection points. We said asset class behavior told us that we're pushing this envelope. Is there anything that's telling us to keep an open mind about this case where inflation expectations fall and bonds might do well? The answer is yes. The indecisive behavior in the markets aligns with the potential for a trend change. S&P 500, or SPY, was in the exact same spot in February that it was in June of 2014. In March of this year, it was at the exact same level that it was in November of 2014. And this week, we are basically at the exact same level that we were in February of 2015. In terms of delivering that message with another voice. Those of you that follow along on Twitter know that we tweeted this Yahoo Finance article. Fed has no end game, and the chickens are now coming home to roost. Within that article, they, meaning the policymakers, stumble from one short-term fiscal or monetary stimulus to the next, despite overwhelming evidence that they only produce a sugar high and grow unproductive debt that impedes long-term growth. Moreover, the continued decline of global growth, despite the unprecedented stimulus over the past decade, suggests we have borrowed so much from our future and for so long that the chickens are now coming home to roost. Getting back to the point, is there anything else that supports inflation expectations failing at that blue trend line, stock prices falling, and potentially bond prices rising? This time from Bloomberg. Volatility in global equity markets over the past year, which often precedes a major trend change, suggests that their risk-reward is negative without substantially lower prices and or structural reform. Don't hold your breath for the latter. This is basically the same message that we've been delivering with these charts, that this type of indecisive behavior speaks to higher risk. Another example that we noted on Twitter, we just had the worst 10-day start in U.S. market history, followed immediately by the sharpest about face in 9 decades. Volatility in global equity markets over the past year. This is significant and very, very rare volatility. How significant has the rally off the February lows been? Really, what we should ask is, have U.S. stocks made a significant new high yet? And charts can help us answer that question. S&P 500, answer, not yet. The Dow Jones Industrial Average, or affectionately known as the Dow, answer, not yet. And the NASDAQ, not even close. To put some context around these charts, this is the peak for the Dow in 2015, the peak for the S&P 500 in 2015, and the peak for the NASDAQ in 2015. This can help us with the model readings and the rules. As we have come off of this low here, obviously the data tracked by the model has improved. In fact, by rule, we were going to have to add to the growth side for the first time in here. However, implementation rules, given this is a lower high relative to this high, this is a lower high relative to this high, implementation rules are in whipsaw mode to try to minimize the probability of a rally and then a give back. Therefore, the market will decide which way we move here. We are open to these lines starting to slope in this direction. It just hasn't happened yet, and thankfully, none of the if-then levels derived by the rules were exceeded on a closing basis. That is obviously subject to change, but we need to see it, not anticipate it. I'm going to move quickly through some of these may be helpful charts. The NASDAQ did not recapture this blue line here, and the NASDAQ is still down year to date. Here is where it finished last year. This is where it was trading on Friday, May 6th. This is global stocks, ACWI weekly in the ETF world. This wick here, you can see intra-week. 3 weeks ago, it looked as if we were getting a bullish breakout above this trend channel. Then by the end of the week, we gave it back and closed below the blue line. We're still in we'll learn something either way mode. Similar concepts here. Daily, FTSE All-World Index, global stocks, the move from A to B. We moved back to the 61.8% retracement and have started to move in the other direction. And we did not make a higher high on this index relative to the October, November, December highs. Obviously subject to change. The broad New York Stock Exchange Composite Index weekly still has not cleared this area of potential resistance. Bullish odds would improve if the NYSE weekly can clear this line here. We've been down now 2 weeks in a row. NYSE Weekly, Friday, May 6th. This is our A to B move. We're still below the 61.8% retracement. This is a 60-minute chart of the S&P 500 as of 3 p.m. on Friday, May 6th. 1 point here. Armageddon cannot take place in the equity markets until we make a lower low, a significant lower low on the 60-minute chart. That would be a drop below 2033. The intraday low on Friday was 2039 and change. We'll learn something either way on this chart, bullish or bearish. Price is still in this downward sloping trend channel, and on Friday we closed below this red line here. Obviously, we have an open mind about what's going to happen next, but nothing particularly impressive about this move here yet relative to meaningful higher highs. Could stocks rally next week? Of course stocks could rally next week. Were there any reasons to be patient relative to that expectation? Yes. Resistance recently, what once was resistance, may now act as support. To drop below this blue line here on Friday, we would have need to close below 2035. The low was 2039. Some patience is in order on this chart as well relative to the potential for a move in this direction. If, and I emphasize if, price is going to move in this direction, we can learn something from this move here, which is sharp and similar to this move here. Notice this is the highest point here. Look how long it took in terms of days, weeks, even maybe months before we get resolution. We never make a higher high here. This high is lower than this high. This high is lower than this high. It took time for the strong intermediate term trend to roll over. It is possible that we will see something similar here even under bearish conditions. Obviously, this type of look is negated if we move into this direction here, and we would learn something about bullish probabilities. This trend channel here says there's still some white space up here, also helping us keep an open mind about a move in this direction. Price will guide maximum flexibility, open to all outcomes and everything in between. Nothing particularly new on the VIX. It's still holding the blue line that we've been watching. Wilshire 5000 also helps with the open mind. There's still some white space here if price chooses to fill it. And obviously, there's a lot of white space in this direction here. Another chart we'll be watching. We may be able to learn something either way. This is short the Dow relative to the S&P 500, or short versus long, DOG versus SPY. You can see here the ratio 2015 starts to rise in May of 2015. That's when stocks peaked. Here in November, December, the ratio starts to rise again. There's a peak in the S&P 500 here. We're back down near a similar level. We also have an angle divergence here. Price is making a lower low on the ratio, and RSI is, for the most part, flat. Here you can see the two angles side by side, telling us to keep an open mind, potentially in the next few weeks, about a move in this direction. Notice how long it took to really get a sharp move in this direction. This is a lot of time in here and quite a bit of time in here as well. Same exact concepts here. PSQ, SPY, short tech relative to the S&P 500. Ratio moves in this direction, stocks fall. Ratio is trying to right itself in a similar area. We'll learn something either way. Similar concepts here. Short relative to long, SH, SPY. Here's RSI. Here is the slope for the ratio. Here is the slope for RSI. We'll learn something either way near the blue line. Here's another ratio that's going to tell us it's going to pay to be flexible. XRT retail, risk on relative to TLT, risk off treasuries, resistance, resistance. You can see what the S&P 500 did here. This is now looking like the potential for a failed breakout. Would be bullish for equities if the ratio can move in this direction, and potentially bearish if this acts as resistance. A few concerning things on the weak dollar friendly chart of EEM, or emerging markets daily. Notice RSI, look how low it is here. It hasn't been in that area since the early stages of this rally here. We also have somewhat of a slope divergence. You can see price here. Look how far RSI falls and how much steeper this slope is. Here we have another divergence. Price makes a higher high, and RSI over the same period makes a lower high. Gold, daily, GLD, Friday, May 6th. The longer price can hold above these blue lines, the better in terms of bullish odds. The trannies, IYT in the ETF world, a drop from A to B. We're still below the 61.8% retracement on the weekly chart. We've covered this ratio in the past, so we'll move quickly here. High beta SPHB relative to low volatility SPLV in the ETF world. This is the S&P 500 here. You can see the ratio starts to peak here. It takes time for the stock market, then it falls. Ratio kind of consolidates. Stock market goes sideways, then falls. Takes some time here for the ratio to make up its mind. Takes some time for the stock market to make up its mind, then it falls. We'll learn something either way here. Inflation expectations win or start winning if we move in this direction. Deflation or lower inflation expectations win if we move in a manner like this. Similar concepts relative to the inflation expectation chart using tips relative to IEF. The big picture will become clearer relative to what happens near potential resistance here. If we get a move in this direction here, that typically would favor bonds over stocks. If we get a move in this direction here, it tells us probably that inflation expectations are rising, and that's more of a wild card, telling us that we're near an inflection point where stocks could be the winner. Bonds could be the winner. Stocks and bonds could be losers, and commodities potentially could be the winner. Doesn't matter who wins once a trend emerges, and it will eventually. We don't have trendless markets forever. Once a trend emerges, the data, the rules, the model, the indicators, and the risk-on, risk-off ratios will help us find that trend. The key to success going forward is consistent implementation relative to the model, the hard data, the rules, the facts, the indicators, and the risk-on, risk-off ratios. If commodities are the winner, the hard data won't miss it. If stocks win, the hard data won't miss it. If bonds end up being the winner, the hard data won't miss it. And conversely, if commodities are losers, bonds are losers, or stocks end up being losers, the hard data and the facts, it is mathematically impossible for the facts and the hard data and the moving averages to miss it. Therefore, we'll head into next week with a flexible, unbiased, and open mind, and we'll also add in a dose of patience. How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currencies, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog short takes, or watch past videos on the Shavaco Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.